Hey everybody, welcome back to my channel. Today's video is going to be essential for you to listen to the whole way through if you want to get wealthy investing in the stock market. Recently, in April of 2025, we saw a 20% pullback in the S&P 500, which is our major US stock index. This was a scary time. Headlines were flying, the fear was flying. However, as a market veteran, I would say, not only have I been trading and investing in the markets for over a decade, but I'm also a financial planner. So, I've got a lot of screen time with price action in the markets. And while everyone was freaking out, I was actually seeing this sell off as a big, big opportunity. And I'm going to talk about in this video what I was seeing at the time before the full sell off even happened back in March of this year 2025, and I am going to walk through all of the clues that brought me to investing during this market panic. So when the market was selling off March through April, a lot of people were fearful about tariffs and how they would impact inflation, how they would impact demand for goods. Many of you may be looking at this today thinking, oh my God, kicking yourselves for not buying the market because the market has continued to make all-time highs. It recovered with a major V bottom, essentially, right? This huge V bottom is what we call this type of price action. We sold off 20%, boom, V bottomed right off of the lows into all-time highs. And we've been making new all-time highs basically every day, many days in July, right? Even today, I believe we made an all-time high. So many of you might be kicking yourself thinking, oh my gosh, how did I miss this? Why did I not invest? Why was I not buying stocks? Well, this video is going to cover the clues that I tuned into to help me come to the conclusion that this sell-off was more likely going to follow 2018's footsteps versus 2022 or even 2008 or, other bear markets that we've seen historically. So let's dive in. So in the wealth building community, I periodically do classes depending on what's going on in the markets. Back in March, I did a video for the wealth building community. I also did a video or a class in April on surviving a bear market, and we discussed these clues that I'm going to talk with you about today. But back in March, this is a snippet from one of the videos that I created. So take a listen. Originally, did not think that 5,000 was going to be a potential level that we were going to see this time around. However, my opinions are starting to change on that. And this is something that I think is now officially a possibility. If we end up breaking down to 5,000, that will put us into not necessarily an official bear market. We'll be getting close to bear market territory, but what it does from there really will depend as far as are we going to stay in a bear market or not. Because as we saw back here in 2018, we saw a very quick recovery, kind of a V bottom. So I think this is probably the 2018 scenario is the more likely scenario versus the 2022 bear market grind scenario. I think we're going to maybe, we could see the 20% drop and then quickly V bottom back as that is where dip buyers will finally see some value in this market. But of course, there's a lot that could happen between now and then with tariffs and just the political landscape and tax reform and tax extensions of the Tax Cut and Jobs Act of 2018. So there's just a lot that we don't know. However, I do think the 2018 sell-off and V bottom scenario is going to be the more likely scenario. And if I zoom into when that time. So basically what I was saying in that video is I was foreseeing a V bottom sell-off and rebound similarly to what we saw in 2018. And you can, look back to see what 2018 looked like. You can zoom in on that price action. And that's exactly how things panned out. So how the hell did I know that? I didn't know that. Nobody out there, no guru out there on the internet talking about investing in finance knows exactly what the market is going to do. But what we're doing as investors and traders, for those of you that are traders, I'm a trader as well, we are using the data we have to come to a educated guess on what we think is going to happen with market direction and how we think market participants are going to act. So nobody knows, but I had clues to lead me to have an educated guess that led me to taking action in the markets and buying stocks versus being absolutely afraid and listening to all the headlines and having paralysis from all of the fear and the unknown. I don't let that happen. The clues started with studying prior bear markets. This is key, okay? Use the past to try to help you decide how to handle the future. And yes, the past doesn't predict the future, but a lot of times it rhymes. So I'm going to share some of my slides from this class that I did back in April for the wealth building community members. And I'm going to show you kind of how I came to this idea that 2018 was the most likely repeat scenario. Is time telling? How fast do we get to that negative 20% mark? That is essentially where the bear market starts, at negative 20%, and then it can go much lower from there. But oftentimes, just like in 2018, we kind of scathe by and we just hit 20% and bounce right back, right? At the time, what I was looking into was I was studying the bear markets and how long it took them to reach negative 20%. So in 2022, it took 5 months to get to negative 20%. And then we were in a bear market for roughly 9 months after that. And then when we look at the 2025 correction, okay, we got to the negative 20% mark in just 1.6 months. Much faster. We got to negative 20% much faster than in 2022. 3 times faster at that. Now, something I've learned from being a trader and investor for so long is that how quickly a stock or index moves to a certain level or has a large move very quickly, typically the faster the move happens, the quicker you're seeing a pullback or you're seeing a bounce, depending on which direction that it's going. So when we look side by side, 2018, which is the correction basically that I thought we were going to be repeating in 2025, which turned out to be true, looking at 2018 and looking at 2020, these were very fast moves, very fast sell-offs. 2018, 2 months to negative 20%. 2020, 1 month. Granted, 2020 was kind of a crazy thing and it was unique in its own right. Nonetheless, we see here, the faster the move happens, the less time. Usually we're seeing V bottoms when those types of moves occur in that short time frame. So this was kind of my first clue, like, okay, well, when I compare these very fast moves to negative 20% plus, depending on if it was a correction or a bear market, versus 2022, you can really see the difference in the price action being more grindy, really kind of not respecting the 200-day moving average very well. A lot of unsure price action, so to speak, is kind of my clue. And then versus these sell-offs that, they're very fast through the 200-day moving average. They don't hesitate. If they come back and retest, they're quicker to kind of bounce off of the 200-day. So you can kind of read into the price action historically to get some clues into how a certain move is going to potentially go. So this was definitely huge in my conclusion that 2018 was the more likely scenario that we were going to copy. The other thing that clued me in was the macro picture at the time. When we see recessions, we see deterioration in the macro data, like big time. And we just weren't seeing that at the time. I would say that things were weakening. The labor market was weakening. We were starting to maybe see a tick up in certain metrics, or a tick up in delinquencies, like credit card delinquencies and things like that, which are still a concern today. However, it wasn't recession level deterioration, or at least the signs weren't really starting for that yet, in my opinion. So I was also, not only that, looking at earnings estimates for S&P 500 corporations. If earnings estimates were still expected to be positive, well, that's not really recessionary either. And they were actually very positive. And 2026 was even more positive than 2025. So that got me thinking, that's weird. We know tariffs are an issue. We know things are starting to deteriorate. However, corporate earnings are still, booming. So if corporate earnings are booming, and granted, this can change depending on what happens with the economy, but at the time, if the estimates were that high, clearly there was something that maybe the bears were missing here. So I was trying not to get too bearish when I was looking at the macro data. And I can show you some of this data. I mean, this was the unemployment rate, right? This is 2024 going into 2025. You can see that the unemployment rate really hasn't come up a lot. It's ticked up a bit from from this 2023 low, of course, but this was historically low unemployment. So of course we're not going to stay there forever. That was a very unique time, but this really looked okay to me in April of this year. And then the other thing that I look at, I like to look at continuing jobless claims and initial jobless claims as well. And so we'll start with initial. This has stayed pretty tame. Yes, we've had an uptick here or there, but look, it's been going down. Back in April, it wasn't anything. Back in April, it was actually pretty low. It was low. So this wasn't a concern. Continuing jobless claims back in April were not a concern. They really haven't started ticking up until recently. And the market's just been making all-time highs in the face of increasing continuing jobless claims. But really what this is saying is, initial claims have been going down, meaning people are maybe not losing jobs at the same rate. However, maybe they're having the people that have lost their job are having a little bit more trouble getting another job. So, but generally speaking, this data is still looking pretty good, and this unemployment rate was fine. So that was another kind of clue into, hey, a lot of people are talking about how we're going to see a 50% plus sell-off in April, meaning a bad bear market, like a 2008 style bear market. But 2008 looked different too. And 2008 was a whole different beast on so many levels. And I put that here in my presentation that this is a chart of the 2008 sell-off, aka bear market. Okay, this was a terrible time. If anybody was involved in it, it was scary. This was the scenario in April that people were worried about. We had fallen 20%, and people were worried that we were going to continue to fall 30, 40, 50 plus percent in the stock market due to the tariffs and all of that. But again, this was an unforeseeable, well, not unforeseeable for some, but it was a disaster that was a different beast. Our financial system literally collapsed, and people were getting loans that they shouldn't have been getting, low quality borrowers. Of course, it was going to blow up eventually. And when you compare 2008 to when we were looking at this in April of 2025, you can just really see the stark differences in loan borrower quality, in overall savings, in overall balance sheets, at the banks. Granted, credit cards and auto loans have kind of been an issue, but nothing that's been screaming recession, right? Because of the low unemployment rate, the low continuing and initial jobless claims. The retail spending data was still actually decent and is still decent today. There were a lot of differences where people were getting super bearish in April of 2025, and I just wasn't seeing it. Again, another clue to, hey, maybe this will be more like a 2018 sell-off. So again, I didn't know that we were going to have a V-bottom bounce in the S&P, but I definitely had enough evidence and enough clues to cue me to not be afraid to be investing, and that this was very much more likely to look like 2018, 20% down, V-bottom bounce, boom. And wow, did it just copy that to the T if you compare the price action between the two. So if you found yourself kicking yourself for not investing more when we did see a 20% correction, I also want you to remember this. Anything more than a 10% correction is probably going to be, one of those things that doesn't come around all the time. So 10% down, 20% down, 30% down, even if you can't pinpoint it exactly and nail the bottom, just invest when the market is down significantly, right? When the market is down more than average. A negative 20% correction, the market is down a lot more than average. That would be a time you would want to be putting in capital. So instead of being fearful of those times, say, okay, I'm going to invest. The market is down. The market is not typically down this much. Let me put capital in. If the market continues to go down from here and we do see a 30%, 40%, 50% bear market, just keep investing. Just keep investing. If you want to get wealthy in the stock market, you have to start to run towards the fear, run towards the corrections, run towards the bear markets. That's how you get rich in the stock market. You get to buy stocks that are down a ton that you've maybe been wanting to buy for a long time that have been too expensive. It's the best. So I encourage you to think like a contrarian. I encourage you to not be binary with the way you invest. Oh, I only invest if the market does this. Don't do that. It's not going to work for you. You have to be flexible. You have to be open. And so now I'm going to share with you my bear market survival checklist so that you can use it going into the next correction or bear market. I apologize, this did not format correctly, but we'll go with it. So the first thing is capital buckets. Know your capital buckets. Are you looking at a short-term capital bucket? Are you looking at a long-term investing capital bucket? A trading capital bucket? We want to make sure that we are properly managing trades or investments for the proper capital bucket that it's in. You don't want to be managing a short-term trade like a long-term investment and vice versa. And that leads into the time horizon. Okay, your time horizon matters. If the market was down 20% and you have 10, 20, 30 years until you're retiring, why are you hesitating? That's just unnecessary. You have so much time ahead of you to compound. Why wouldn't you want a 20% discount on stocks? So time horizon matters. If you are nearing retirement, that's a whole nother ballgame. That's a whole nother way to manage your capital buckets. So just keep that in mind. Look at history. This is the big one. This is actually what led me to buying stocks during the market panic, not being afraid. If the market was going to continue to sell off and I would have been wrong, I would have kept buying stocks. Look at history for clues. That's my biggest takeaway for this whole video. Analyze the risks and environment. This kind of goes back to comparing what was going on in April of 2025 versus what was going on in the 2008 bear market financial crisis, right? To look at the risks, look at what's going on around you, look at the macroeconomic data, try to put it all together to decide, how you really should be feeling. To me, I did not think that the economy was about to collapse by any stretch of the imagination in April of 2025. So that is key, is kind of looking at those risks. You also, with that, have to accept the unknown. You're not going to nail buying the bottom of the market. You're not going to nail selling the top of the market. Maybe sometimes you will, but it'll be coincidental. It'll be accidental. It won't be because you're a genius. And so I think that's important. You have to go into investing knowing that you're not going to know, right? And you're just doing the best you can with what you have and with what history tells you is possible. Plan for bounce trades. If you're a trader, I'm a trader. I know a lot of traders. I work with traders, and plan for bounce plays when those bear markets come or those big deep corrections come. Typically, there's going to be bounce trade opportunities there. And then last, just keep investing. There is really a lot of power in being a contrarian, not being afraid of the bad times. All right, finance fam, I hope that was helpful, because guess what? A deep market correction or bear market is going to come again in the future, maybe even the near future. I don't know. We'll see. The markets run a lot, right? So maybe a big correction is on its way. But hopefully I've at least given you some kind of framework you could use. Avoid getting stuck in that fear trap. It's really bad, and it'll really affect your ability to build wealth if you're too fearful. I know plenty of people that have missed buying. They've been in cash and they've missed these buying opportunities, and we've had many of them over the years, and I know people that have missed multiple. You have to really hone in on that skill set that you can develop over the years to be a better and better investor and build more and more wealth. Hope you found this helpful. Leave me a comment below if you did, please, and if you want to see more videos like this, and I'll see you next time.